In this segment, we will discuss Chapter 2, Financial Reporting Theory. So Chapter 2 is for you to know and to understand the conceptual framework for accounting. So in order for you to read and understand financial statements, you must become familiar with the conceptual framework under which the financial statements were prepared. Therefore, this chapter highlights the ways in which authoritative literature and guidance are grounded in the conceptual framework and discusses how the objective of financial reporting and the elements of financial reporting are part of the conceptual framework. The learning objectives for Chapter 2 are: explain what a conceptual framework is and why it is important in accounting standard setting. 2, define the objective of financial reporting. 3, describe the qualitative characteristics of financial information, including the fundamental and enhancing characteristics of financial reporting. 4, identify the elements of financial reporting. 5, demonstrate an understanding of recognition and measurement in financial reporting, including general recognition principles, revenue and expenses recognition, and accrual accounting. And 6, explain the assumptions used in financial reporting. So the first objective, what exactly is conceptual framework? So in this first objective, we're going to explain what a conceptual framework is and why it is important in accounting standard setting. So what is a conceptual framework? Well, a conceptual framework guides standard setters when developing new accounting standards. So a conceptual framework and accounting standards should be consistent. They should be consistent with each other. So in Chapter 2, we will explain and examine the following conceptual framework components. One is the objective of financial reporting, characteristics associated with high quality financial information, elements of the financial reporting system, and recognition and measurement criteria. Here you see in Exhibit 2.1, it illustrates the relationship among the conceptual framework components. So specifically, the exhibit shows how the objective of financial reporting flows through the qualitative characteristics, the elements, the measurement and recognition, and constraints leading to financial standards for preparing financial statements. So in this way, the financial statements are designed to meet the objective of financial reporting. Exhibit 2.1 also illustrates the use of the conceptual framework in developing new standards and justifying existing standards. The FASB is currently revising the conceptual framework. Here in Exhibit 2.2, it summarizes FASB's 6-topic project initiated to revise its conceptual framework. So the first topic on the objective of financial reporting and the qualitative characteristics has been completed. The FASB is currently working on elements, measurement, presentation, and disclosure. The other topic is inactive. So at the current time, FASB and IASB are working independently on the conceptual framework. Here in Exhibit 2.3, it provides a detailed overview of the current conceptual framework. You have the objective of financial reporting, then you have the qualitative characteristics of financial reporting, elements of financial reporting, and the principle of recognition and measurement in financial reporting. And we discussed that earlier. So the IASB's objective and qualitative characteristics are identical to US GAAP. However, they differ. They differ in the descriptions of elements and of financial reporting and the principles of recognition and measurement in financial reporting. The IASB is also currently revising its framework. So in Objective 1, what is conceptual framework and what is the purpose of it? Well, as I mentioned earlier, a conceptual framework, it sets forth theory, concepts, and principles to ensure that accounting standards are coherent and uniform. Its purpose is to assist standard setters in developing and revising accounting standards. And we'll go into Objective 2, which is define the objective of financial reporting. According to the conceptual framework, the objective of financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors, and making decisions about providing resources to the entity. Now, those decisions involve buying, selling, or holding equity and debt instruments, and providing or settling loans and other forms of credit. The conceptual framework indicates that the primary users of financial information are the investors, lenders, and other creditors who cannot demand information from the entity. Investors also require financial information to form an opinion about a company's future cash flows and earnings. And many of the standard setting board decisions are based on those needs. Many of the standard setting board decisions are based on those needs. So we're finished with Objective 2, defining the objective of financial reporting. So according to the conceptual framework, what type of information should be provided to users of financial information? According to the conceptual framework, what type of information should be provided to users of financial information? Is it A, comprehensive, B, accurate, C, useful, or D, detailed? Which one of those? A, B, C, or D? And your answer should be C, useful. The information should be useful. Okay, so this is the end of Learning Objective 2, and we're getting into 3. 3 is describe the qualitative characteristics of financial information, including the fundamental and enhancing characteristics of financial reporting. The objective of financial reporting is to provide useful information for decision-making by investors, lenders, and other creditors. What characteristics make financial information useful? So what are some of the characteristics do you think would make financial information useful? The conceptual framework divides the qualitative characteristics into fundamental characteristics and enhancing characteristics, and discusses the cost constraint on providing information. Fundamental characteristics are those basic characteristics that distinguish useful information from information that is not useful. So the fundamental characteristics are those basic characteristics that distinguish useful financial information from information that is useful. And the FASB identifies the two fundamental characteristics as relevance and faithful representation. Relevance and faithful representation. Financial information is relevant if it is capable of making a difference in decision-making by exhibiting the following attributes as you see listed here: predictive value, confirmatory value, and materiality. Information has predictive value if decision makers can use it as an input into processes that help forecast future outcomes. For example, companies report sales revenue each year. Financial statement users may use the prior year's revenue to predict future revenues. Information that has confirmatory value, if it provides feedback about their prior evaluations. For example, financial statement users, they often compare reported net income to prior earnings forecasts. Now, information that is material states that if reporting, information is material if reporting it inaccurately or omitting it would affect financial statements users' decisions. So again, information is material if reporting it inaccurately or omitting it would affect financial statement users' decisions. The materiality of an item can depend on its size or nature. The conceptual framework does not specify a quantitative threshold for the materiality of an item, nor does it identify the specific nature of items that would be considered material. Rather, whether an item is material depends on the company and its financial reporting. Preparers and auditors must use professional judgment, of course. They must use professional judgment to determine the materiality of an item. For example, whether or not a $5,000 loss is material would depend on the size of the firm, right? Do you agree? Yes, it depends on the size of the firm. The second qualitative characteristic, faithful representation, it indicates whether financial information depicts the substance of an economic event in a manner that is complete, neutral, and free from error. The depiction of an economic event is considered complete if it includes all information, both descriptions and explanations. Okay? So the depiction of an economic event is considered complete if it includes all of the information, both descriptions and explanations necessary for the financial statement user to understand the underlying economic event. For example, a company reports a balance of long-lived assets on its balance sheet. From this amount, a financial statement user cannot fully understand the company's investment in its long-lived assets. A complete depiction of a company's long-lived assets includes a description of the nature of the assets, the balance by type, and a description of the depreciation method used for each type. Information is neutral if it is free from bias in both the selection and the presentation of financial data. For example, assume that Nestle company has 3 lawsuits pending at the end of the year. Okay, so this company, Nestle, it discloses information only about the lawsuit that it expects to have a favorable outcome, but not the 2 from which it expects unfavorable outcomes. So in other words, they only disclose information about 1 lawsuit and how favorable it may become for them. But they do not disclose the 2 that may have a bad outcome or unfavorable outcome for them. So this is considered bias. So this bias reporting does not faithfully represent the firm's financial position. Information is reported free from error when there are no mistakes. Hello?
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 Hi, Dr. Ahmed. This is Jeanette from your class 250.
Yes. Hi, Jeanette. How are you?
I'm good. How are you?
I'm fine, thank you. So you have my name and your first name.
Yes, I know. We have to say.
Almost the same name, huh?
Yeah.
Yeah. So how are you doing?
I'm doing good.
Good, good. So I understand that you're working Monday through Friday during the times that we have class.
Yeah.
Okay, is this a new position that you just received? Because you accepted the, when you enrolled for the class, it's actually scheduled for the same, for the time.
Yeah, and I read it, but I didn't know because I have my other classes, I didn't need a Zoom for, the other class that I took, my professor said it's not mandatory, so I thought maybe it's gonna be the same thing. But when I went back and I read the description, like I have to be there at 10. But yeah, the position that I have is just I've been there in I think it's 2 months. I mean, they moved me to another location, so it has been for 2 months right now. Yeah, and I don't know. I tried to talk to them, but they said they couldn't give me that time.
Okay. So how many more classes do you have?
I'm sorry?
How many classes are you taking?
I'm taking 2 classes right now.
Okay, so is this one and another class?
Yes.
Okay, and the other class is fully online, or is it?
Yeah, it's fully online.
Oh, okay. 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 Well, I know I told you that we could possibly talk by Zoom, but I had an early start this morning, and I completely forgot about the Zoom. I knew that I needed to talk to one of the students, but like I said, I completely forgot about it. So
yeah, I logged in, but I didn't see no one connected. So I was having a trouble, but then I didn't see anybody the other side, and that's why I went ahead and emailed you.
Yeah, it wasn't going to be a class. I just wanted to really talk to you and find out what's going on, why you enrolled for the class, knowing that it was going to meet Tuesday and Thursday from 3 to 5. But like I said before, I think in my introduction, I am very flexible. I want to see my students succeed, and I am willing to to help you succeed in the classroom. So because you're not able to attend on Tuesday and Thursday, well, you're not the only one. I've had other students to reach out to me also, and because of everything that's going on here in our country, we don't need when I say we, I'm meaning all of us. We don't need extra things to worry about. So I can tell you, Jeanette, don't worry about it of the attendance, but I do ask you, and not only you, but I ask those that are not able to make it, if they are willing to do extra work.
Yeah, sure.
Okay.
Yeah.
Okay.
Sure.
Okay. Well, that's fine. I will let you all know what it is. Maybe you have to prepare some type of case or report or something like that. Okay.
Yeah, thank you for understanding that.
Oh, of course, I understand. Like I said, I'm flexible and I'm willing to work with my students to help them succeed.
Thank you. Thank you for doing that.
Okay. Now, if if you ever run into any problems, whereas you're unable to complete your assignment on time, or something happens, then life happens. Okay. I would prefer you to text me, send me an email to let me know before and not after the fact. You see what I'm saying? In other words, you have an assignment that's due tomorrow night. Okay. I don't want a person to call me or email me Monday and say, "Oh, I'm so sorry. I forgot," or whatever. I just want you to give me advance notice. Okay.
Yeah, understand.
Okay. Like I said, I'm here for you. Just reach out to me and let me know.
Thank you.
You're welcome. You have a great weekend, okay?
You too, Dr. Annie. Thank you very much.
You're welcome. Bye-bye.
Bye-bye.
Where was I? Providing all relevant and representationally faithful information available is costly. As a result, the conceptual framework stipulates that standard setters should compare the cost of requiring information to the benefits derived from presenting this information when developing accounting standards. Standard setters consider cost for both financial statement reporters and for its users. A company consumes a significant amount of resources in collecting, processing, verifying, and communicating its financial results. New standards or significant revisions of existing standards require companies to increase training, update their accounting systems, and renegotiate existing contracts based on updated accounting information. On the other hand, if the information required under a new standard is not provided to the users, they incur costs in obtaining or estimating that information on their own. Thank you for watching this video, Chapter 2, the Financial Reporting Theory. This is Part 1, so please stay tuned for Part 2.